Last week was massive for the S&P 500 as it climbed over 5,800 points for the first time ever, and we have some very exciting things taking place over the next few days. Some very large companies that are reporting that can have a wider effect on the overall market. But today our focus is going to be on Global Payments. Now this is a company, in essence a fintech one, that provides payment services to consumers, merchants, issuers, and it's very similar to some other big names that you may have heard like PayPal, Square, Stripe and Aiden. Now when we take a look at this company itself, it is down around 13% just over the last 12 months. Over the last 5 years, it's down 38%, but over the last 10 years, it has performed fairly strongly nonetheless at 178%. Now, this is a company that trades towards its 52-week lows, and we do get a double buy signal from Seeking Alpha and Wall Street, although we do note that Quant gives this a hold. Now, we're reviewing this because it has some massive upside, one that we quite like, and we want to understand, is this one we should be adding into our portfolio? Now, also very briefly to mention, it does have a forward yield at the 1% point and a fairly low forward P at 8.66. Now, when we take a look at how this company has performed in terms of their last earnings, well, always great to see, 100% track record, so they have beaten analyst targets, and over the next 4 quarters, something that we don't see a lot, they are anticipating double-digit growth every single quarter to the EPS on a year-on-year basis. Therefore, we do note over the next full year, December 2025, they expect it to increase, lowering the forward PE to 7.79. Now, we also want to flag just a few things from their latest investor presentation, which took place on the 7th of August. And the first thing to note is that for their quarter, their revenue was up around 6%. Their operating margin, which we always like to see efficiencies in, showed 40 basis points increase. And we also note the earnings per share was up double digits at that 12%. Remember, they are expecting that to continue for at least the next 4 quarters. When we take a look at their guidance, well, for the 2024 full year outlook, they are expecting growth, maybe not as high as the market wants to see at the double digit rate, mid to high single digit at 6 to 7%. They still expect overall to have some expansion of 50 basis points to the operating margin, and the earnings per share, as we just covered, some nice growth at the 11 to 12% point. Now, when we go back and actually look at some of the underlying metrics of the company, you will be able to understand this is a high quality company. However, it does have some flaws. Now, dividend safety, a score of 70 looks to be good. We're going to cover dividend yield theory as well as this undervaluation signal, but we do want to highlight they haven't increased their dividend for at least the last few years. Now, in terms of the dividend safety score itself, it was reaffirmed at the back end of August this year, and it also means a dividend cut is unlikely. No surprises given they haven't even increased it over the last few years. Now, in terms of some key metrics from the last recession, the 07-09 Great Recession, in fact, they maintained the dividend. They didn't increase it, but at the same time, they didn't cut it. They had plus 7% sales, which was well above the average of the S&P. It was around negative 12, and they also outperformed the S&P, negative 38% return, S&P during the same time, negative 55. Now, as we've already mentioned, no growth since 2021. However, over the last 5 years, on average, given they have increased it very rapidly, it is up 90% year on year. Over the last 20 years, 17%. So it does look very good from a historical standpoint, but we have to re-emphasize that they haven't increased that dividend in quite some time. And whilst we see 0 years of consecutive increases, they have been paying dividends for 22 years without a reduction. This undervaluation signal comes from looking at the 5-year P ratio in comparison to the 5-year average. And when we zoom over the last year, this blue tunnel or bucket in essence shows the expected intrinsic value or the fair price, and we know pretty much over the last 12 months it has been trading well below that. Now, we're going to get into more detail covering the discounted cash flow valuation, but that is just something to consider. On top of that, when we do look at dividend yield theory, this tells us a company is undervalued when the current yield sits above the 5-year average. That is what we get to see here, an undervaluation signal, and in fact a double undervaluation on these models, given the fact the forward P is 8.3, lower than the 5-year rolling of 13.4. We also note the financials as a sector sits higher at 12.8. So there are a lot of undervaluation signals for Global Payments, but remember, we're not looking at any one of these models in isolation. We will conclude when we come to our valuation model shortly. Now, the free cash flow payout, always focus on that, as the earnings is susceptible to manipulation by management through accounting. Below 60%, that is what we see every single year. In fact, 9% anticipated over the next 12 months. This shows us that this company isn't heavily focused on dividends, because if they really wanted to, they could increase it at quite a substantial rate. So something to understand for those prospective shareholders. Then we move on to the free cash flow per share, where we want increases over the longer term. It has more than doubled over the last 10 years, but again, notice it has been fairly flat over the last 6 to 7 years. But interestingly, over the next 12 months, they do expect it to nearly double. So this company is clearly inconsistent, but moving forwards, they are expecting growth in what we would say as to be some very important metrics for this company, and in fact, companies as a whole when you do come to review them. Now, sales growth 3 to 7% is what we want to see at bare minimum, but we notice this company does have some fluctuations. Over the last 3 years, it has looked very strong, 7% on a trailing 12-month basis, and as we saw when we looked at their investor presentation, for their total top line for 2024, they're anticipating 6 to 7%. Now, that isn't too bad, but ideally we do want to see some double-digit growth to their top line, just to keep up with this company, which has historically been very fast growing. Now it has started to slow down. Over the last 10 years, pretty much tripled their top line. In terms of shares outstanding, though, we do have to note here, they have diluted your position if you were a shareholder since 2015, as they have issued equity. Now, the other way to look at it, if you are a more recent shareholder from 2020, they've actually been doing share buybacks, and you could argue that maybe they aren't doing those dividend increases at this moment. They do believe their own company is trading at a historically low valuation, and therefore want to focus on buying back as many cheap shares as they possibly can. Then we move on to one of our favorite metrics, ROIC. 10% or more, give us faith management are able to effectively allocate their capital. Not great historically speaking. The positive to note though is from 2019, 2020, the lows of 2%, it has started to increase 6% on a trailing 12-month basis, and this is where we would say when we come to the valuation, we do need to consider adding a little bit of a margin of safety just for this reason alone. Now, operating margin, good to note, is above the minimum 12%. We want to see efficiencies increasing over the longer term, and that is something we do get to see here. 16% in 2015, 23% in 2023, and in fact, just from the last 4 years where we saw the lows of 12%, this company has been focusing on that margin expansion. So, positive sign, especially for those newer shareholders. And free cash flow margin looking very healthy. Again, a little bit inconsistent. Nonetheless, though, in the high teens, in the 20s is a very good sign. We then move on to the net debt to EBITDA, one of the downfalls of this company. EBITDA referring to the earnings before interest, tax, depreciation, amortization. We want below 3. What we can see, it's been straddling around that nearly every single year, and the numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand. 3.55, pretty much an increase from the 2020 lows. The positive, again, to consider, it is anticipated to come down over the next 12 months to 3.3, but still that is higher than what we want to see. So something we'll consider, and we'll look at that as well when we do have a quick snapshot of their balance sheet. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning, so we are releasing one tomorrow where we run through what's happened in the market as well as some undervalued stocks that we do believe deserve your attention. So do click on the pinned comment below, sign up and read straight away. You will also be able to get access to our 36 undervalued stocks for the month of October to consider in your portfolio. We cover how much upside they have according to Wall Street and mention those that sit within our own portfolio. And today you can also grab our 22 undervalued dividend stocks that Wall Street believe have the most upside. So again, click on the pinned comment below, sign up, and you can read straight away. Other parts of our analysis include looking at insider institutional movement. Insiders around 1% with 2.55 million worth of sales over the last 12 months, but we do note nothing in the more recent quarter of Q4. In Q3, we noticed around 166,000 worth of sales. Q2 nearly double at 367. When we take a look to see who these insiders are, first thing to note, 8th of August, so you could argue around 2 months ago, a little bit outdated, but that total sale was around 166,000. We don't consider this to be a bearish signal. Insiders sell for many reasons, personal, financial. Right here, we want to capture any insider buying, which we do believe to be a bullish signal. Now, looking at the institutional aspect, 90% ownership, pretty high, one of the highest we've seen on the channel, around 2.2 billion worth of sales over the last year. Same time period, nearly double that at 3.81 billion. and we noticed over the more recent quarter of Q3 and Q2 and Q1, so pretty much in 2024, institutions as a whole do quite like GPN and have been buying more than they've been selling. Regardless, always do your own due diligence and never copy what insiders or these institutions do. Now, we've covered their top line revenue, so we will focus on their bottom line net income, but just to highlight, the revenue has been, whilst inconsistent, moving in the right direction, around 3 billion in 2015, pretty much tripling to 9.7 in 2023. Now, the story that we're focusing on here is the bottom line, where again we do see inconsistency. In fact, 2022 it did drop significantly, but if we look at it from a 10-year point, it has increased from around 278 million to 987. So this shows us, similar to the top line, the bottom line net income has also pretty much tripled. Then when we take a look at the health of this company, their total cash versus their total debt, from a graphical perspective, we can see, like their revenue, like their bottom line, cash has been trickling up. 651 million in 2015, 2.1 billion in their latest quarterly report. And here we want to essentially compare it to their total debt numerically and directionally, because one metric, whether it's cash or any others, in isolation doesn't really tell us anything. And this is what we saw, that there is a bit of a worry. Their net debt to EBITDA is climbing higher, in fact above the 3 that we want to see. And on a year-on-year basis, it is increasing, going in fact from 2.3 billion in 2015 to 18.2 in their latest quarter. In fact, just look over the last few years, it has been steadily increasing at a little bit of a worrying rate. Again, something we can consider in our margin of safety. Now let's get through some gradings. The first one is valuation. Now they get a D. Typically, we like to look at it on a P non-GAAP basis. 8.66. The sector median does trade higher at 12.6. So right now, if you're buying this company, you are getting a discount of nearly 30%. Do remember though, some companies warrant a discount. Question you have to ask is this one of those companies? Or in fact, is the market overreacting? Or do we have a massive opportunity today? Pretty much every other metric we do get a sense of a discount, but again, will depend on which one you want to use. Then when we look at their growth, they get a B-. Now revenue year on year, just under 7%. Sector median 4.5, so a little bit better. Moving forwards, 6.6, again a little bit better than the sector median. What we have to point out here is though, on the earnings per share over the next 3 to 5 years, it is anticipated to grow 11% year on year. The sector as a whole, not too far off it at 9.93. So we already noticed now that this company is trading at a discount to the sector, but in terms of the growth, it is marginally higher. So that is a good sign in terms of undervaluation. Then we move on to the profitability, where we get a B+. Gross profit margin, again, marginally higher, 63% versus 60.4. Bottom line, actually, it is worse off, 14.3, with the sector median at 22.34. What we do, however, like from this company, their cash from operations, very high, 2.24 billion, significantly higher than the sector at 160 million. Now, a quick summary for this part of the analysis: a double buy rating from Seeking Alpha and Wall Street, a hold from Quant, D on valuation, B- on growth, with a B+ on profitability. Now, two things before we jump into the valuation model itself. Let's see how firstly they compare to others in the sector. As we can see, they are all in the transaction and payment processing services of a very similar size. Now, over the last year, let's see, does the issue isolate to this company, or is it in fact to the sector? Well, two of these companies have had negative returns over the last 12 months. We have GPN down 12%, not great at all. When we look over the last 5 years, we actually note again negative performance, but this time we also see the majority of companies have also returned negative, so not a good industry to have invested over the last 5 years. When we look to over the last 10 years, we actually notice some of them have performed fairly decent. GPN up 189%. Now, what we also like to do is compare this to the S&P 500, and over the last 12 months, no surprises, S&P looking very strong, up 33%, GPN down 12%. When we zoom out to over the last 5 years, again, we can see that massive difference between the two. Over the last 10 years, though, when we do zoom out, what's interesting to note is that GPN was in fact performing significantly better, although in this 10-year period, we do notice it did come down. Question then remains, do you believe it will be able to outperform the S&P? Are we getting a great valuation price today, which means we will be able to see longer term gains that do outperform S&P 500? Otherwise, as always, you can consider low cost ETFs like VO, like SPY. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value today at $139 comes from the DCF model, and when we take a look, we have the free cash flow year on year, average growth at 27%. Now we've gone for a 10% growth rate moving forwards. In fact, here we have a low, medium and high. So with the medium at 10%, the discount rate at 8%, we get the present value of future free cash flows and terminal value. We add the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see, if you believe this moving forwards, there is around 39% upside. As always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for GPN or any others that you do desire. But as always, for transparency, we'll show you the 8% rate in this model today. Gives you an intrinsic value of $112, indicating upside but around 12%. Likewise, for those that are a lot more bullish, a lot more optimistic, at the 12% rate, $170, indicating 70%. So what we're going to do is take through that median rate at 10%, as we can see, significantly lower than the 10-year average, and we get now essentially our margin of safety. As always, we use 10% execute if it meets the 3 golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that, in today's episode, we'll look at buy at $125. Then we keep going till it's near the current trading price, and what we see in today's episode, you aren't getting a 30% margin of safety just yet, but it does sit somewhere between 25 to 30%. Now that is very strong. As we saw, the company does look good. The earnings per share previously and expected look to be very strong. There are some metrics that we like, but also some considerations like the debt levels, which have been increasing at a little bit of a worrying rate. The question you have to ask is, will they be able to essentially pay a lot of that down, or in fact just have all of this under control? We also know Wall Street have over the next 12 months a price target of $139, pretty much in line with our intrinsic value, and they see 39% upside over the next year. So is this one you're looking to add with a 25 to 30% MOS, around 39% upside over the next year? Is this one maybe on the watch list, or in fact maybe one that you are looking to sell or have sold before? Give us your thoughts in the comments below. If you enjoyed the episode, smash the like button, hit the subscribe and bell button. Don't forget to sign up to the free weekly newsletter. We are dropping the latest article tomorrow morning. And as always, come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.